For decades, tobacco companies faced a problem with no obvious solution. Their most profitable product was slowly disappearing. Cigarette smoking has been declining across many wealthy markets, governments keep tightening regulation, and younger consumers are less interested in traditional tobacco. Yet one of the industry's fastest-growing products does not contain tobacco at all. Nicotine pouches are small packets placed under the lip, and companies such as British American Tobacco and Philip Morris International increasingly see them as a potential successor to cigarettes. BAT now predicts the global nicotine pouch market could generate about £11 billion, or roughly $15 billion in annual revenue by 2030, up from around £4 billion in 2025. That would make nicotine pouches larger than the vaping market according to BAT's projections, with an estimated 47 million users worldwide by 2030. The attraction for tobacco companies is not difficult to understand. Pouches are compact, relatively inexpensive to manufacture, easy to distribute, and do not require batteries, heating devices, or complicated electronics. More importantly, they give companies a way to keep selling nicotine even as cigarette consumption declines. Reuters reports that BAT CEO Tadeu Marroco considers the category a potential long-term replacement for cigarettes. The transformation is already visible. BAT sells Velo, while Philip Morris International owns ZYN through its acquisition of Swedish Match. In the first half of 2026, BAT's nicotine pouch volumes across Asia, the Middle East, and Africa increased 27.5% to roughly 700 million pouches. BAT's Velo also reached a 39.2% share of the modern oral category across its key markets, up 8.4 percentage points from the end of 2025. In the United States, Velo's modern oral market share reached 29.8%. Philip Morris has built an even larger position. Its ZYN shipments reached 2.9 billion pouches during the second quarter of 2026 alone. The company is expanding the product portfolio while its broader smoke-free business now represents about 42% of total net revenue. That means the company behind Marlboro outside the United States is increasingly generating its growth from products that do not involve lighting a cigarette. The business model explains why companies are pushing so aggressively into this category. A cigarette is an extraordinarily profitable consumer product, but it comes with enormous regulatory, litigation, and reputational costs. Vaping provides another nicotine delivery system, but manufacturers must produce electronic devices, batteries, heating components, and liquids. Heated tobacco products require dedicated hardware as well. A nicotine pouch is mechanically much simpler. It is essentially a packaged consumable that customers repeatedly purchase. That simplicity can create attractive economics. There is no expensive device that needs to be subsidized to attract users. Products are small and lightweight, reducing shipping and storage requirements. They can also be sold repeatedly without relying on a reusable hardware platform. Reuters reports that nicotine pouches are growing faster than vaping and heated tobacco, attracting investor attention partly because of their potential margins, but the really interesting strategy is not simply replacing one nicotine product with another. Tobacco companies are trying to rebuild themselves as multi-category nicotine businesses. BAT now says it wants 50 million consumers of its smokeless products by 2030 and wants at least half of company revenue to come from smokeless products by 2035. Its portfolio already includes Velo pouches, Vuse vaping products, and Glow heated tobacco. The company explicitly says its long-term ambition is to become predominantly smokeless. Philip Morris is following a similar path. Its smoke-free portfolio includes IQS heated tobacco products, ZYN nicotine pouches, and vaping products. During the second quarter of 2026, its total net revenue reached $11.2 billion, up 10.4% from a year earlier, while smoke-free revenue grew faster than the company overall. PMI says smoke-free products are now available across 109 markets. This creates an unusual corporate transition. These companies are not abandoning cigarettes overnight. Cigarettes still generate enormous cash flows, and in many developing economies traditional tobacco remains a large business. Instead, cash generated by cigarettes is helping fund the products that could eventually replace them. They have global distribution networks, relationships with retailers, regulatory teams in dozens of countries, manufacturing expertise, enormous marketing budgets, and decades of experience managing products with age restrictions and complicated regulation. When a new nicotine category becomes commercially important, they can scale it rapidly. Philip Morris acquired Swedish Match in 2022 for approximately $16 billion. Largely gaining control of one of the strongest oral nicotine businesses in the process. What initially looked like an expensive acquisition increasingly resembles a strategic shortcut into one of nicotine's fastest-growing categories. By early 2026, PMI Investor Materials described ZYN as the leading U.S. nicotine pouch brand, with quarterly volumes measured in billions of individual pouches. BAT is trying to close that gap with Velo. Its latest results show substantial market share gains in the United States, even while the company remains much stronger in several European markets. In Denmark, Velo held more than 92% of the modern oral category in BAT's reported data, while its share exceeded 50% in markets including Sweden and the United Kingdom. This is where the tobacco industry's next corporate war may emerge. Cigarettes created powerful global brands such as Marlboro, Camel, and Lucky Strike. The next generation could be fought around ZYN, Velo, and other nicotine pouch brands. But unlike cigarettes, this market is still young enough that leadership can change rapidly, and there is another reason companies are interested. Cigarette companies have historically depended on pricing to compensate for falling volumes. If cigarette consumption drops a few percent, manufacturers can often raise prices enough to keep revenue or profit growing. That model works surprisingly well, but it cannot continue forever if the number of smokers keeps shrinking. A growing nicotine category gives the industry something it has lacked for years: actual unit growth. That does not mean the transition is guaranteed. The same regulatory pressures that transform the cigarette market could eventually reshape nicotine pouches as the category becomes larger. There is also a strategic contradiction. Tobacco companies present smokeless products as alternatives for adult smokers, but commercial growth becomes harder if those products only replace customers who already use cigarettes. Investors want expanding markets. Regulators and public health authorities worry about new users. The larger nicotine pouches become, the more closely governments are likely to examine who is using them and how companies are attracting customers. BAT itself acknowledges that long-term transformation depends on regulators and public health institutions as well as consumer behavior. Its official target is to shift existing adult smokers towards smokeless alternatives, while eventually reducing dependence on combustible cigarettes. Competition may also pressure margins. A simple product can be inexpensive to manufacture, but that also makes the category easier for rivals to enter than something like advanced semiconductor manufacturing. If dozens of brands compete for the same consumers, companies may need to spend heavily on promotions, retailer incentives, and product development. Market share could become more expensive to defend. Still, the scale of the opportunity explains why big tobacco is willing to take the risk. BAT estimates the nicotine pouch category could nearly triple in value between 2025 and 2030. Philip Morris is already shipping billions of ZYN pouches per quarter. BAT is gaining share with Velo. Both companies are simultaneously reducing their strategic dependence on traditional cigarettes. The most important part of this story is therefore not whether nicotine pouches become fashionable, it is what they could do to the economics of an industry that has spent decades managing decline. Cigarette companies used to make money because smoking was widespread, customers were highly recurring, manufacturing costs were low, and brands had extraordinary pricing power. Many of those characteristics can potentially exist in nicotine pouches too, but without the combustion that defines traditional cigarettes and without the expensive electronics used in vaping. That is why the product matters so much strategically. The tobacco industry does not need cigarette volumes to suddenly start growing again if it can move millions of consumers into another recurring nicotine product. And if pouches are cheaper to manufacture, easier to distribute, and still capable of supporting premium brands, the replacement business could eventually become extremely profitable. The companies that once built global empires around cigarettes are now trying to repeat the same basic business model in a packet small enough to fit beneath a consumer's lip. Whether regulators allow that market to become as large as the industry expects remains uncertain. But the direction of corporate investment is already clear.